Oil surged this week. Gold fell. The S&P 500 fell too. At first glance, that looks like one obvious story: geopolitical risk rose, so markets became defensive. But that explanation breaks the moment you look at gold. If every risk event created the same safe haven response, oil, gold, treasury bonds, and the dollar would move in a neat line. They do not. This week, WTI crude oil climbed about 9.7%, from roughly $74.53 to $81.77. Gold slipped about 1.1%. The S&P 500 lost about 1.3%. And the 10-year Treasury yield ended slightly lower near 4.54%. That is not a contradiction to explain away. It is the structure. Safe haven is not one trade. Different assets are responding to different risks at the same time. Begin with oil. Crude oil is not a simple fear gauge. It is a price for physical energy, so it responds to supply routes, production, inventories, transportation risk, and expected demand. When oil rises sharply, it can mean markets are pricing a tighter energy balance. It does not automatically mean every risky asset has the same reason to move. This week's WTI move was large enough to matter. The contract reached a high near $82.07 and spent much of the hourly sample with RSI above 70. Its closing RSI was about 78, and price sat near the upper Bollinger Band. Those readings do not tell us that oil must reverse. They tell us that the move was fast and stretched. A fast move can continue, stall into a range, or retrace. The indicator describes the current pressure, it does not issue a command. Now compare gold. Gold is often grouped with oil under the broad label of geopolitical assets, but their mechanisms are different. Oil can rise because supply becomes less certain. Gold can rise on demand for protection, but it also responds to real and nominal yields, the dollar, liquidity needs, and prior positioning. Gold opened near $4,066, reached about $4,113, then ended near $4,023. That is a loss of about 1.1% despite a week in which energy risk was clearly visible. Gold's weekly low was near $3,963, showing that sellers were active even after the market tested higher prices. So an energy shock did not produce a universal defensive bid. It produced a split. Oil priced a tighter physical market, while gold faced a different balance of rates, currency, and flows. The dollar helps show why the label can be misleading. In a risk event, the dollar can attract demand because it is a funding currency and a highly liquid place to hold cash. But this week the dollar index actually slipped modestly, from about 101.1 to 100.8. That means the simple sentence "a stronger dollar pushed gold down" does not fit the whole weekly move either. The dollar was not the only driver, just as oil was not the only measure of fear. The 10-year Treasury yield adds a third piece. It eased from about 4.58% to 4.54%. A lower yield would normally reduce one source of pressure on a non-yielding asset like gold. Yet gold still ended lower. Again, the point is not that the usual relationship failed forever. The point is that it was outweighed this week. This is where macro analysis can become careless. It is tempting to turn one headline into one trade: conflict means oil up, fear means gold up, weakness means yields down. But markets are not a single mood meter. They are connected auctions with different buyers, different constraints, and different time horizons. Oil buyers may be responding to immediate physical supply uncertainty. Gold sellers may be reducing positions after an earlier rise, funding losses elsewhere, or reassessing future inflation and policy. Treasury buyers may be responding to growth risk even while oil traders price supply risk. All of those mechanisms can exist together. A good explanation has to allow for several forces without pretending that we can read every order ticket. The observable question is whether the cross-market pattern persists or begins to converge. The equity market gives us a useful confirmation test. The S&P 500 fell around 1.3% for the week and finished near the lower Bollinger Band. Its hourly RSI ended near 21, a very weak short-term reading. That does not prove that high oil caused the equity decline. Corporate earnings, technology leadership, rates, and broader risk positioning all matter. But higher energy prices can create an inflation problem at the same moment that weaker equities create a growth concern. That is the uncomfortable mix markets are trying to price. If oil stays elevated while equities remain under pressure, markets may increasingly have to decide whether the dominant risk is inflation, slower growth, or a combination of both. If oil retreats and equities stabilize, the shock may look more contained. Neither outcome is guaranteed by today's data. Here is the validation map. For the oil story, watch whether WTI can hold above the week's opening area near 74.53 after such a sharp run. Holding above it would show that the repricing has not fully unwound. A rapid return below it would show that the market has given back the initial risk premium. These are observation points, not instructions to buy or sell. For gold, watch whether the 3,963 low holds and whether price can reclaim the 4,113 high. Gold holding its range while yields and the dollar ease would show that the conventional tailwinds are finally gaining force. Continuing weakness despite those inputs would preserve the divergence. For the broader macro picture, watch whether equities recover while oil remains firm, or whether both stay pressured. The first combination would suggest investors are separating an energy supply shock from broad earnings risk. The second would keep the inflation and growth tension unresolved. The next scheduled checkpoint is the Federal Reserve meeting on July 28 and 29. It will not explain every barrel of oil or every ounce of gold. But it can change expectations for rates, inflation, and the dollar, which are the channels that connect these markets. The useful reaction map is simple. If oil stays high, inflation sensitivity remains visible. If long yields and the dollar respond sharply to policy expectations, gold may react differently from oil again. If equities and bonds both weaken, the market is pricing a more difficult balance than a single risk-off label can capture. So why did oil rise while gold fell? Because safe haven describes a purpose people assign to an asset, not a law that forces every asset to move together. Oil priced physical supply risk. Gold traded its own mix of yield, currency, liquidity, and positioning. Equities reflected a separate debate about margins, growth, and financial conditions. That is the lesson to keep. Do not ask which asset is giving the one true answer. Ask which risk each asset is pricing, what would confirm that reading, and what cross-market move would prove it incomplete. Subscribe for the next Weekend Lab, and follow the daily market notes at Market Validation Lab on X.